Welcome to Growth and Exit Strategies for Software and IT Companies, the flagship tech conference of the World Financial Symposiums. The GXS conference caters to tech founders and investors in tech M&A, covering topics like investments, growth strategies, buyouts, sales, divestitures, and mergers. Thank you for joining us. Let's begin.
It's time to move on to the buyers panel, moderated by Tim Goddard, Executive VP of Corporate Strategies, and Tech Trends Guru, answering key questions such as what's important to buyers acquiring in the AI space and what can you do to maximize value.
All right. Well, welcome to the buyers panel here at this Growth and Exit Strategies event. I'm Tim Goddard, EVP Corporate Strategies at Group, and I'm thrilled to have a fantastic panel with some really great luminary individuals from across both strategic and financial acquirers here. So I'm going to get out of the way here and let our panel introduce themselves. So, guys, if you just want to give us a quick sort of elevator pitch overview of kind of your current role. And you know what you do and who you do it for and with. I think that'd be great. That'd be a great way for us to start off. So, Pavel, why don't we start with you?
Great, team. Super excited to be here today. Pavel, head of M&A at SaaS Group. We are a serial acquirer of product-led growth software companies. So the companies that primarily grow through self-service motion, cloud-hosted, and serving all the way from solopreneurs to large enterprises. We are present today in multiple countries in North America and Western Europe, have acquired 25 companies since inception, 450 employees globally, and looking to acquire between 4 and 8 new companies every year.
Right. Daniel, why don't you next?
Thank you for having me, Tim. It's nice to see some familiar faces and some new ones. I'm Daniel Benami, a principal on the Astra Capital Management Investment Team. I lead growth buyouts for Astra. We're a DC-based investment firm. I focus mostly on AI, cloud, broadband, tech-enabled services, and cybersecurity businesses. Typically companies with enterprise values up to $500 million, positive cash flows, and our mission critical focused on solving big challenges for society, industry, and the customers community served. Looking forward to being on this panel with you, Tim.
Great. Sharon.
Thank you, Tim. It's a pleasure to be here. I'm Sharon Van Zeeland. I lead strategy and corporate development for Rockwell Automation. We're driving the future of industrial operations across hardware, software, and services. We've done about a dozen transactions over the last couple of years, and we're focused on profitable companies that help expand our portfolio, as well as our geographic reach. So pleasure to be here. Thank you.
Thank you. And then Don.
Hi, Tim. Thank you. And thank you to all the great peers that are on the panel as well. So Don Penland, I'm actually with KNOX Capital. So we're a lower and middle market investment firm, investing in a variety of different tech-enabled businesses. I think unique to my background is recently moved over from operating for the last 20 years and a strategic buyer over to now, investing full-time and financial buyer. And we're very focused right now on a variety of IT consulting companies, managed service providers, again, in the lower middle market. Thank you.
Thanks, Don. And Mike.
Hi, Tim. Mike Magliochetti. I'm an operating partner with Riverside Partners, a lower middle market, healthcare tech-enabled a PE firm. I've been with the firm for about 13 years. Prior to that, I spent 20 years in industry, ran 3 companies through successful sale transactions before joining Riverside. Riverside's been around for 36 years, and since day one, really focused on founder, majority management-owned companies that are on a strong growth trajectory, healthy businesses, and at a point in their life cycle where the founders want to take on a partner to take that business to the next level. We really like to say we sell picks and shovels to the gold miners. We don't take any binary risk, any molecule or device risk, but we'll provide services to those companies that do. So pharma services, laboratory services, contract manufacturing, tech-enabled healthcare services. Investing out of our 6th fund today, have about $1.2 billion under management.
Great. And then Derrick.
Thanks, Tim. Pleasure to be here today. Derrick Raymond, Managing Director at KPMG. I've started the Corp Dev capability for the firm back in 2010 and led a majority of KPMG's transactions. Since then, my current focus over the last 18 months or so has been in our advisory business to accelerate the growth of capability largely. That's people and technology across all the industries we're in and our strategic priorities. And most recently, that's been in AI. And we've closed one transaction earlier this year, and we're going to announce another one in the next few hours or so. So, pleasure to be here.
Fantastic. I'm glad we ended with you there on the intros, because I want to stick with that concept and really dig in, because we've got a great one of the things I'm excited about on this panel is there's a huge diversity in terms of kind of focus, both on business model, on strategic versus financial approach, on scale and kind of maturity of the business across the board. So I want to dig into that a little more, and we'll start with you, Derrick, kind of keying off what you just said. So I'd love to understand, when you look at partnering with, acquiring, investing in a business, what are the key characteristics you're looking for? And particularly, since it's kind of the overall theme here, specifically around AI and how you look at that aspect. And I suspect we'll get some very different answers here. But Derrick, why don't we start with you, since that is kind of your focus?
Yeah, perfect. Thanks, Tim. And the AI space is rapidly changing, and it changes almost on a on a weekly or monthly basis. So it's a lot to keep up on. There's a broader ecosystem that we're playing in as a firm, and the acquisitions we're looking for are helping us as a firm and our people be more efficient in serving our clients, but also capabilities that our clients are needing as they transform their business. So, and we're seeing our industry, the broader consulting industry, being disrupted, and we're preparing ourselves for what the new environment might look like. So some of the technology that I've been leading in our acquisitions fit across that game board. And we're thinking differently about creating center of excellences across our firm, and the new capabilities that we need going forward.
Great. Then Mike, how about you? Obviously very different approach, but how were you grappling with the same environment to some degree?
Yeah, it's interesting. We buy when it's we look to buy when it's a true platform and not a point solution. And I look at, where we play in the subsectors in which we play in pharma services, as opposed to tech-enabled healthcare services. On the tech-enabled healthcare services side, for us, we're really seeing that there's niche expertise. There's lots of in-house talent and experience within our portfolio companies. So it really makes sense for us to try to develop within to build. And it's really, for us, we look at the AI adoption trends are highly fragmented and highly specialized in that subsegment. But on the other hand, in pharma services, we're finding more platforms that are more mature, and with respect to biomedical modeling and simulation in silico, drug discovery, dose selection. And so companies with more, at least from my perspective, where we play, more momentum and more kind of stand on your own 2 feet kind of characteristics with respect to AI solutions.
John, how about you, kind of in the services space?
Yeah, I think, from that perspective, what we're looking at specifically, where our current investment thesis around IT consultancies or managed services partners, echo what Derrick and Mike said first, like looking at the operational pieces, that seems like the low hanging fruit. How can we improve margins and those perspectives? And then second, I think and I'll agree with Mike on the fragmentation. I think it's fragmented in every vertical right now, right? As everyone's trying to figure out what's real and what's hype, from that perspective. But, really then helping how these different services companies can help their clients with real revenue growth with these tools, right? Whether it's a SaaS business or any other vertical business, and how they, first again look at that from an operational perspective, but then where the real goal is, right, is how does it help them grow revenues and help them expand into maybe new markets faster from that perspective.
Sharon?
Yeah, so at Rockwell, we focus on the factory, right? Industrial automation is our core. So for us, we're looking for AI solutions that help manufacturers become more efficient with the pending labor shortages and all of the discussion around enhanced efficiency. We think about particularly quality management systems. We've invested in an AI company that helps speed up quality checking. So that's one area. And then data analytics is another for us. And similar to the other speakers here, we're looking at verticals. Pharma, life sciences is critical to us, food and beverage, auto EV. There are point solutions that help those types of manufacturers be more efficient. So for us, it's about factory data and efficiency.
Daniel, how about you?
Just to echo Sharon's point, I think there are some major challenges that remain in the ecosystem for technology businesses, for AI companies, and for companies that are looking to integrate best of breed AI tools. Whether those challenges are infrastructure related, DevOps, platform as a service, and real ROI on enterprise AI adoption, my view is that modern technology companies need more than just capital to build lasting value. They need patience. They need transformative growth and operational playbooks that help their leadership teams become nimble and satisfy the needs of the evolving customer ecosystem 2 to 3 years from now, not just today. So my view is that these rapidly evolving industries across technology, communications, AI, and the physical manifestation of a new general purpose technology like AI needs a partner who can help navigate those challenges.
So it almost sounds like, Daniel, you're making the argument that with something that moves as quickly as AI does, in a partner, you actually want someone that is more patient and more stable, kind of making the argument for looking at private equity over kind of maybe getting on the venture treadmill. Am I reading too much into that, or is that fair to say?
I think you're right, Tim, that the pace of change is so dynamic that being nimble, but also being durable, I think is the most important to build lasting value in this sector.
Yeah. I think that's one where you're not going to get necessarily a lot of disagreement from this group. And then Pavel, how about you?
Super good question. I would say that as a PLG SaaS acquirer, we are essentially witnessing a significant increase in the number of owners that are trying to sell companies that are affected by AI. And if you actually think about all the large AI companies, they're all PLG tools like Claude, ChatGPT, Cursor, etc. And what we have been witnessing that a lot of people that thought they had a very good business 3 years ago before ChatGPT, and if you think about tools like image enhancement, avatar generation, various text editing tools, right? Even like Grammarly, right? You thought you were on top of the world doing 4 or 5 million revenue with high profit margins. And now these tools look increasingly out of date, almost like 20, 30-year-old. And they are really struggling to sell. They're trying to reinvent themselves. At the same time, there are a lot of tools that I think that were created too fast early on. Like, for example, at some point in the pipeline, we had a tool that allowed you to chat to a PDF, which sounds a bit ridiculous because you could chat to PDF using Claude, right? And there were people that actually made a lot of money doing that. So now they're trying to sell. And so we're witnessing a significant number of sellers trying to monetize the assets. And I think 99% of them would essentially become obsolete. And so we are actually continuing to focus on genuine business use cases where AI would somehow help you enhance the business, but ultimately the business use cases that still require humans and will not change in the foreseeable future. And so there's a lot of pipeline noise. We have to be a lot more analytical and really, really curious to see, like in 6-7 years, which of those companies will survive, because then hopefully we'll have opportunity to buy those companies that have shown a earnings growth for 6-7 years afterwards.
So I'm going to throw this one open because I'm not sure if everyone necessarily will have one off the top of their head, but would love to hear kind of any kind of recaps or anecdotes on sort of AI related deals, whether that is sort of pure play AI, or whether it's somebody that has been able to leverage AI in an interesting way within a vertical or within a point solution. Would love to get kind of anybody to give us an overview of any deals you've done or been involved with recently that kind of fall into the broader, on one side or the other of that AI story.
Well, I've got a couple of things, Tim. I kind of look at it's been an evolution, at least for me, over the past year, 18 months, with looking across our portfolio of companies and seeing the adoption of AI take place, and at the same time seeing deal flow that has, increased reliability, if you will, or on AI. So if I just look across our portfolio, just for a minute, and share with you, one of our companies in tech-enabled healthcare services, a company called Unislink, which does front to back end revenue cycle management services for physician practices across a multitude of specialties. What they've done is they've layered in data science tools, ML, to it's just such low hanging fruit with a business like that to automate these repetitive tasks and provide predictive insights. We have about 1,000 employees, a large engineering group, and have decided to build rather than buy AI just because of the expertise and the niche type of business that this is. But we've over the past year, this company has implemented, accounts receivable, denial predictors, work allocators, chat bots, agentic AI, and it's really changed the trajectory of the company. I think we've reduced there's 100 in headcount just by implementing AI on the just to pivot a bit. What we're seeing for deals, which I find really exciting, beyond that is and I'm partial to it, is in the pharma and biotech space. Really with accelerating new molecule discovery, clinical trial design, optimizing patient inclusion, exclusion criteria for clinical trials, and then this whole area of in silico, modeling, biomedical modeling and simulation. Looking at a few companies today that do quantitative systems pharmacology, where they're predicting drug interactions on the molecular, cellular, tissue level, clinical trial design, dose selection for clinical trials. What that all equates to is just really condensing and accelerating and making the timeline a heck of a lot more efficient for these companies. And if you can, align yourself with a service provider that's working with pharma and biotech to do that, it's really exciting sector for us today.
It's great. It's great. Anyone else, deals you'd like to sort of give a shout out to and think might be useful to profile?
Yeah, Tim, I've got one which I think is a good example where AI could actually create an enormous investment opportunity. So I had an exclusivity for an acquisition earlier this year that was sort of a enterprise software company with very good retention metrics, very good growth, available at a very good price, had a very good management team. The product itself had AI characteristics, but it was not that important, right? It was like a number 2 player in Europe in the target vertical. We actually ended up not proceeding with the transaction for one reason. We couldn't get comfortable with the customers. The customers are incredibly big and blue chip organization. I can't name you the sector, but it's a sector that everybody knows. But we just had a bit of a conviction that AI will completely eliminate the sector. It's a little bit service related, right? And so what I'm trying to get at, I think if you possess a certain domain knowledge, goes very, very deep into industry, there will be a lot of industries that venture capitalists don't like, even private equity don't like, right? I don't want to speculate, but let's say if somebody had the thesis that, hey, with AI, you need less lawyers, meaning you need less software, right? And there will probably be certain, I don't know, legal software or any other software that people don't want to buy anymore. And if you could actually know that that's not the case, you could go in and acquire a lot of great businesses at a very good price and then continue running them, at 4, 5, 10% organic growth for the next 10, 15 years and make a lot of money out of it. So everyone is really, really scared these days, like what's going to happen. And, every single day you hear these updates, this sector is dead, this sector is dead, and so on. So that for me was a good example where I probably would wanted to do the deal, but I just lacked an internal conviction and domain expertise for that particular sector to kind of go against the grind and says, nah, it's going to be here 10 years. I'm buying a really good business and it's going to be a good return for me.
Yeah, it's an interesting time because some things change a lot faster than you think. We've all seen that, but then a lot of other things change a lot slower than anyone expects, and you have to kind of address both of those. Derrick, you got something?
Yeah, Tim, thanks. So I'll highlight the transaction we're announcing. It should be today. And this is a company. I mean, every company claims to be an AI company, but are you really an AI company? So it's what sort of capabilities that you have does this company possess that allows one to take advantage of the new world, driven by AI. And synthetic data is a challenge our clients are facing in terms of how to use synthetic data. We're going to be running out of data pretty soon as a world, and there's not a lot of confidence in some of the synthetic data that's being produced. So our clients are struggling with this because data feeds AI, and so we're acquiring leading experts with technology to build a center of excellence within KPMG to support our clients across our tax advisory and audit businesses, to bring the best in thinking of that to our clients. And that's something I think that, although it's really it's an AI business, but it really helps our clients take advantage of the data element. So
Great, that's exciting.
Yep.
Daniel.
Raymond, you mentioned a few marketplace gaps that I think are particularly relevant in a lot of the deals I'm seeing right now, whether it's synthetic data or enterprises concerned with privacy, control, security, and compliance of their data. The status quo is implement first, worry about performance, control, security second. So we've been longtime investors in the cloud. We've watched the evolution of the CPU cloud to GPU cloud. We view that generative AI kind of looks like high performance compute in the cloud, albeit very different internet architecture requirements to support those applications. So we've seen a few trends recently pick up across the last 2 to 3 years, which all support a global demand for AI infrastructure, which is substantial, growing, and wholly inadequate based on current spend. That's all creating the need for a lot more capacity, data center capacity, server investments, investments at the data layer to support new model parameters. And it's also requiring service providers to think about how do we manage the new AI cloud infrastructure that will be required to support these applications. Enterprises still have their deployment and service challenges. And so that's led us to invest in a couple of platforms which we believe solve some of the complexity, performance, privacy, and in one case, sovereignty challenges that enterprises face. One of our portfolio companies, DartPoints, is an owner and operator of data centers in the US, focused on supplying mission-critical enterprise workloads with low latency, high performance, high throughput compute storage in market, rather than going to tier 1 markets in Ashburn and New York. One of our other portfolio companies, Nscale, is an AI hyperscaler in Europe, which combines data center ownership and service delivery to provide AI infrastructure at scale for large tech companies, governments, and enterprises who are still really concerned about deployment, serviceability. How do I make the most of my AI investment?
Great. Anyone else want to cover something?
I'll just touch on one thing. I think Daniel kind of touched on it, but I think it's worth kind of double clicking in a little bit. And that's really kind of the idea behind, I think part of the theme of this panel is to help sellers understand, what buyers are looking for from that perspective. And I think, as we think about our due diligence, 2 things kind of come to mind. One, the defensibility of the business. I think Pavel spoke on this a little bit on the deal, that he talked about. The idea of making sure that what you have today, some vibe coder over the weekend can't rebuild that application and knock you out of contention, right? Or out of business, from that perspective. being a little extreme with that, but to kind of really kind of prove that point, giving some of the advancements here in coding and those types of things. So as buyers, I think we would all agree that we're very much looking at that from a defensive perspective and making sure how sustainable the business will be, in the at least the near future, and longer term. And then I think the second, to kind of echo something Daniel said, is really the responsible AI part. I think he kind of mentioned that we're building fast, right? And we're not necessarily putting those borders and boundaries around some of that. And I think as buyers, that's something that we're going to kind of continue to dig in a little bit deeper and make sure how are we protecting against hallucinations? How are we protecting the data sovereignty and those types of things? So I think as sellers, it's very important to make sure as you're thinking about going to market that you've thought through those and have good answers or policies and operations to kind of support those pieces.
Want to switch gears? Oh, Sharon, you got one last highlight?
I was just going to tag into Don's comments there. We can't highlight enough the intellectual property protection in terms of, is it sustainable and going forward? And then I think someone mentioned about customer diversification. That's also super critical for Rockwell. One customer could take the whole business away. So we as a buyer always are looking for, do we actually own the intellectual property that we're buying, and also do they have diversified customer base? It's critical in these early stage companies to have both of those things.
Want to take a bit of a detour here. Mike, you have recently published a book that's directly relevant to kind of the advice that we're giving here. So I just want to give you we got a lot to get to, but I just want to give you a quick opportunity for a commercial around kind of the book itself and how it originated and what people should know about it.
Okay. Yeah, thanks. A challenge that we always face here with founders is really trying to build that bridge. So it's not an us versus them mentality, and to be that trusted confidant. And so just over the years, as I mentioned before, I joined Riverside. I spent 20 years. I ran companies in urology and orthopedics and oncology, diagnostics, and each one of those CEO assignments, I never felt I was qualified for the job when I got the job, not because of imposter syndrome, but just because of the fact that, I didn't spend any time in the sector beforehand. I was an operator. I had returned capital for my investors, but the steep learning curves every time, that serial reinvention process at each one of these assignments, was a real challenge. When I made the move into private equity, complete dogleg left for me, even though I had been an advisor to Riverside for 4 years. I had PE, venture, family office investors in my companies in the past. It was just as steep of a learning curve. And I had a process that I used when I was going through this in CEO assignments where, I would always listen 3 times before I spoke. I would be really deferential to my executive leadership team, who maybe had a heck of a lot more experience in the sector than I did, and just listen, and completely immerse myself in these businesses. Going into private equity, being on the other side of the equation, I used that same process in my learning curve, but I did something a little bit different this time. I kept a journal. Anytime I heard a phrase that I didn't quite understand, or an idiom that someone used that was really kind of clever and descript and maybe so outrageous that I'd roll my eyes at, I wrote it down. I wrote down what it was, what it meant, how it was used, and a little bit of a blurb about it. And I kept that journal as a living document over the years, meeting with other PE firms, iBankers, conferences, RLPs. And late 2021, I was speaking at Columbia, and one of the professors there asked me, quite bluntly, how the hell did someone with a PhD in chemical engineering ever wind up in private equity? What was that learning process like? And I shared with him this journal and how helpful it was to me when I entered private equity. And he said, man, if you could turn that journal into a manuscript for a book, my students would love that. They're mired in finance and business and accounting texts. This is real world stuff. So long story short, 2 years later, I had a manuscript of about 350 pages. I had networked to literary agents, one of whom got behind it, and I knew nothing about publishing or anything like that, but managed to help shepherd this through the process. And the book was just released last month. It's called Dancing Between the Toes of Elephants, and I really wrote it for folks like myself who were working for PE or venture or family office run companies, understanding sort of behind the scenes, the language that's used, the decisions that are made, and meant to be really educational, but entertaining at the same time. And the book, I'm really flattered that the book was #1 bestseller on Amazon and in private equity and venture and career and professional development categories. And we're using it across our portfolio today. Other PE firms are using the book. And so, again, Tim, I don't mean this to be a commercial, but it's been really critical for me here in our firm in building that bridge. It's so important with founders because we're a firm where we never pretend like we know a business better than the founders know a business when we invest. And so we don't want anybody to leave, especially for a platform investment, and being able to foster that unity. It's so important. It's so important for us.
I think it's helpful. We've got a lot of folks on the call who are kind of in that decision mode and trying to decide if that's the right direction for them. That could be a good resource to understand it better. We got a lot more to get through, so I'm going to start doing a few more, just calling out a couple people on a few questions here, just to make sure we get through at least most of what I've got here. AI and timing is, I think we've touched on it a few times. If somebody has a company that is either AI focused or kind of enabling AI, what timing do you guys think about in terms of buying? What timing should potential sellers be thinking about in terms of selling? Sharon, I'd love to start with you.
Yeah, so we need a solid proof of concept and a use case that's been demonstrated. We're a strategic buyer and we run factories all over the world, so we don't want to put something at risk. So we need to make sure that the product actually works and is validated. And as I mentioned, we really like to see customer adoption more than one, and then intellectual property is super helpful for us as well. So those are our kind of critical areas.
Then Daniel, how about you?
I think Sharon hit it on the head. The vision of the team is paramount to us. In addition to the customer relationships, their origins, their deep domain expertise, where do they want to take this thing? There are so many different inflection points and hurdles to navigate. Choosing the right path and having the heart to follow through it is where we want to back these repeatable growth engines. Yes, it's great that the unit economics are maturing. Yes, it's great that the free cash flow profile at maturity and at steady state looks very compelling. But how does the vision drive where we want to spend time around barriers to entry, IP, asset ownership, vertical integration, if that's on the roadmap? How do we take advantage of being early to market, but not too early, learn from others' mistakes, but ultimately position the company really well to capitalize on these tailwinds, which should drive mass adoption 3 to 4 years from now?
Let's move on and kind of key off of that into maybe broader advice. Again, we've got a lot of folks on the call right now who are looking at M&A or recapitalization and trying to decide if this is the right time. What advice do you have for those founders and CEOs in the audience? Pavel, let's start with you.
Tim, this is a great question, and I should probably do a bit of promotion for Quorum, because I believe that if you want to sell your business and if you don't know who is the obvious buyer, because you haven't got enough approaches from strategics like Rockwell or private equity, I think it's a good idea to work with a seasoned investment banker that will introduce you to various great businesses. Because if you're just talking to SaaS Group, statistically speaking, you're very, very likely to get a rejection, and therefore working with advisor, I think, is super important. I always tell people that stay open, right? If you get approached, even if you're not willing to sell today, but you get approached by buyers, don't always say no, have a chat. Try to learn as much as possible. How's the market looking, different valuation approaches, so that by the time you're ready to sell, whether you use or not an investment banker, you at least have a short list of buyers that you could put in the mix. And in this way, you could not only maximize the proceeds for yourself, but also find the right home for your business, someone that will take care of your company for the next 10, 15 years.
Don, how about you?
Yeah, look, I think, a lot of the sellers that we talk to were oftentimes the first institutional capital that they've ever taken on. I think very similar to Mike's model as well. So, it's a lot of the basics of, clean financials, easy for us to figure out margins, right? Across the different product lines. Have you actually productized most of those? And then we tend to look for higher reoccurring revenues. So, kind of removing some of the volatility and risk around either client concentration or just revenue coming in, period. So agree with Pavel, often, taking the conversation and learning of, kind of what buyers are looking for, I think is a great way to educate yourself to get the business position to go to market.
Um, Feel free to weave in advice as we go, but I'm going to keep moving through some questions here. And the big question.
Could I,
Oh, yeah,
could I
Go ahead, Mike.
I'm sorry, Tim. Yeah. I think this is such a great question. I think going into it for a seller, for an entrepreneur, really understand who the buyer is, PE or strategic, because it's two very different paths, right? On the PE path, of course, you're most likely going to be asked to roll equity. And this is probably the biggest decision you're going to make in the life cycle of the business, and taking on a partner for growth. This is a marriage. This is just like a marriage, but you can't get out of this marriage. So, the valuation is important, but knowing who you're getting into bed with, what life's going to be like, is just as important, because hopefully the second bite out of the apple you take when the firm when you exit, 4, 5, 6, 7 years later, should be a heck of a lot bigger than the first bite of the apple that you take. I absolutely agree that, hiring an investment banker, do your diligence on the investment banker, understand, speak to past clients that they've represented in the space. They should have a good idea of comparative deals. They should have lots of experience in the sector. And just by default, this is going to be a competitive process, right? They'll cast a wide net. They'll leverage their relationships. Maybe they've had prospective buyers who were, interested in a deal that they were marketing that didn't win, and are still interested in the space, that they could call upon them. And what's really important is they'll control the diligence timeline. There'll be a shot clock on diligence after an LOI that the banker will really take control of. And they'll also, of course, run point on negotiations. So I think that's really critical to think through that for entrepreneurs.
That's great.
Hey, I'll echo what Mike says. That's very important, and that marriage analogy is exactly right. I think it's important for founders to date a lot and early on get close and intimate with your ecosystem, with potential partners in the market. You'll learn a lot through that. Because culture is really, really important, especially if you're for your people, for your clients, and finding that right platform. That's the responsibility, right, of the founder and the entrepreneur who knows that best in terms of what the right fit is. And then finding the right advisor through this process is incredibly important too. But don't wait for a process to figure this out, right?
Mhm.
Start much, much earlier and lay the foundation to know who the potential buyers might be, and build those relationships so they get to know you. All right, and vice versa. And then all bankers are different too. So, in terms of what they focus on, the areas, their specialties, the size of companies they're willing to take on. So build those. It's really about building those relationships very early across those different stakeholders in your future.
No, thanks for that. I want to key on something that Mike said, which, valuation, obviously, on the one hand, is of paramount importance, on the other hand, is less important than you think. But at the end of the day, it carries, enormous amount of weight, and it's a question that everybody, again, thinking about the folks in the audience, it's all kind of on their mind. Like, what is my company actually worth? And one of the things that on our side we always say is, look, you only find that out by going through those steps that you guys have all just talked about. Ultimately, that's what it's worth. But you guys have to come at it from a different direction, right? You guys are the data points that we kind of leverage to understand that. So would love to hear your thoughts on this, complex question, and maybe addressing any misconceptions in particular you've seen sellers come to you with. Sharon, let's start with you, because obviously coming at it from that strategic side, it's a different story than maybe the financial side, even if a lot of the moving parts are similar.
Yeah, I'm going to back up for 1 second. So when we look at a company, we're thinking strategic fit, which I think Daniel was talking about. What's their vision? We're thinking financial valuation, which is important. And then the culture piece that I think, Derrick, you were spending a lot of time on. We actually do a culture assessment. So all three are kind of equally weighted, but I'll skip to valuation. So we do traditional valuation, just like most finance professionals do. We do a discounted cash flow. We think a lot about synergies, both cost and revenue. And then we also look at comparables, what's going into the marketplace, what are other companies going for. So we go at it both from our own model as well as what's going on in the marketplace. So that's our methodology.
Right. Don, how about you guys?
Yeah, I think the same. I think Mike touched on something. It's just very important to first focus on the partnership, and making sure you find the right partner. I kind of mentioned that a couple of times. I often make the joke, given Mike kind of blazed this trail, and I just recently met Mike and read his book. But I have a similar story, right? 20 years operating and building businesses, and then sold a couple of businesses, and then decided to, if you can't beat them, join them, right? And do the PE thing. And I often kind of, do the same thing. I sell it as we're very operator first from that perspective, because we've done that for so long, versus trying to financially engineer the business from that perspective. So looking at the culture, how do we really bring value to the business and grow the business around go to market, versus just trying to cut cost. We often see, and I didn't realize it till I got to this side of the table in the last year, there typically is in a lot of sectors a really dark cloud over PE. And I think that's been earned in a lot of ways. And I think, with folks like myself and Mike, who have been operators before, and how PE is now leveraging operators more, and the operating partner model, for outside, past executives more. I think, that cloud will slowly get lifted off. But it's going to take some time, and it's going to take, finding those right partners for those owners as they progress forward.
And the other thing,
go ahead, Mike.
I was going to say, the other thing we do too is we encourage the founders of companies that we're courting to speak to other founders in our portfolio, to get a better feel for who we really are. We could talk to a blue in the face on how great we are and how founder friendly, but we open the playbook and let them speak to whoever they'd like, executive leadership teams or founders who we've backed.
Right. Daniel, back to the valuation side of the question, and in particular, any misconceptions that you often feel you have to clear up during the process. Maybe save some time and do it now.
We think of valuation as very subjective, but it does come down to team, the marketplaces they compete in, and their contracts. Within team, we like to back existing leaders who want to continue running their businesses, but need help, capital, expertise, access to new markets, and navigating these hurdles, and the industry transformation that's happening in the backdrop. So quality of senior leadership is paramount to us. How have you solved challenges in the past? That gives us confidence that you can continue to navigate those industry challenges going forward, and help substantiate your ability to take market share over time. Market, self-explanatory. Are you a software company? Are you a product company? Are you a services company? That business model and the contracts that come with it, in my view, drive a lot of the value attributable to the repeatability of the growth engine, the retention of those customers, your ability to repeatably put capital to work in owning a market. We think of as paramount to the importance of a business and its ability to stay cutting edge, but also navigate the changing industry tides.
I also want to jump in on valuation.
I can say a few.
Oh, sorry.
Go ahead, Pavel.
I can say a few things. I think the biggest misconception, at least in software, is that it's all about ARR multiples. I think it used to EVP 2-3 years ago. I think it's changing now a lot to a profit and cash flow. But specifically for SaaS Group, I think I'm very close to Daniel in the sense that we are looking for the companies that have the right to win in the market through internal processes, through the products, the people. But I'm also very, I guess, close to Sharon in the sense that I want to offer the highest price to the businesses that I actually want to own, right? So I'm trying to shy away from edge cases through companies maybe I don't like outside of my circle of competence. So if it is a business that's run by a sole developer doing 2-3 million EBITDA with fully automated processes, having a strong right of win in their target market, I want to be there in front of that person and pay him the highest price for various reasons, including, like I said, it's the circle of competence, it's my ability to take that business, double, triple that EBITDA, from 3 million to 10 million in perpetuity over all 5-year period. And so for me, it's always about being very, very selective, finding the right markets, and talking about valuation, because I would say a lot of people are still shopping around businesses that are, growing, 10% with zero profit, low NDR, and those businesses are really, really going to struggle to find a home in the next 5 years.
The only thing I would add to all the great comments here would be in some founder businesses, the founder hasn't thought about the next level of leadership and what that business looks like if that founder wasn't around. And so some founders have a view that they've built a business, but really they've built a business around themselves. So we look at businesses that are sustainable really without that founder and that key man risk. And I think that goes to valuation too. So that's just something for the founders out there to be thinking about.
Derrick, I want to stay with you on a different topic, specifically on due diligence, partly because KPMG just sort of looms large in due diligence for everybody, I think. But would love to, how should these folks who are preparing and thinking about M&A, how should they be thinking about due diligence? How do you guys approach it in particular? And I'd love to get kind of a survey on just the size of the team that they can expect to be going over their stuff, because that's something that has, I think, changed pretty dramatically over the last decade.
Great. Well, thanks. Well, we certainly have a world-class diligence team. We do that for our clients. So I'm fortunate that I pull in our team from tax and our FDD and ODD teams and so forth. But it's really we try to do a lot of due diligence early as we go through the process. I would also say, having a right advisor who can prepare and anticipate and be ready so there are no surprises when you get to due diligence and they're prepared for that. I would say in terms of the size, we tend to focus diligence on the key value drivers, what really, really matters, and understanding what makes this business tick, as opposed to crossing every T and dotting every I in a complete diligence, manner. Like there's some things that move the needle and some don't. And I tried to take a phased and thoughtful approach, so we could either, keep going or cut bait in that process.
That makes sense.
Yep.
Mike, how about you?
Yeah, we have this is probably common, but we have an investment deal team that consists of myself, 2 other partners, a principal, a vice president, and a younger associate, and we're with the deal right from SIM through management meetings to IOI through diligence, LOI, right through the closing of the transaction, and you get us for a board, some of us for a board of directors going forward. And as far as the what we really look for, for us, I think management, foundationally a strong management team. There in these types of companies that we invest in, there are inevitably gaps in the leadership team. The founder may be wearing lots of different hats, and so we need to backfill there. lots of time there are there's the company may be growing 10, 15, 20% a year with no formal business development function, just word of mouth, client to client referrals. So the ability to build out that area is really key. And to have a pipeline of potential add-on acquisitions to get into different geographies or technologies or diversification of clients. Some third rail issues, if you will, for us is if we can't get aligned with the founder or the man, or if there's real key man risk, or if there's a highly fragmented market with an unclear path to consolidation, that's tough for us. Of course, if there's price erosion or margin erosion, or that's a watch out factor for us. And someone mentioned customer concentration. That's also key. Customer attrition, looking at the longevity of clients and the right to win, the sustainability, durable differentiation, sustainability of the business is key.
Right. Just a few minutes left. Don, you want to touch on this very briefly?
I can. I don't know that there's much more I can add. I think, we're very similar to some of the other folks. I think, we do try to drive a lot of preliminary due diligence, which means then once we get any kind of formal due diligence, the team that's more, just confirming what we think we know already. And if we built those relationships up, first understanding the sustainability of the business, the management team, those pieces, then it's, we're just doing confirmatory on Q of E and those types of things, right? And we generally try to close them, especially in lower middle market. If we've done our homework correctly, we can usually close in 45, 60 days. And again, always trying to take that operator first approach. We need them to not stop running the business, right? Just because we're going through due diligence. So we're always trying to say, how can we streamline that? How can we try not to put so much burden on the management team? Because the last thing we want is to have an issue with financials later, right, post close, because they had to take their eye off the ball for a couple of months. I think we always try to be sensitive to that, but get the data and make sure that we're making good decisions as we progress forward.
All right, let's pivot here to the sort of the, actually we alluded to it just now, the last thing, which is ultimately how long are they going to be sticking around? And I think different folks have different models. Pavel, why don't you start with you? What do you expect for founders and CEOs after the deal? How long do you need people on?
This is excellent question. So we've done transactions all the way from bankruptcies to buying companies with, I think the largest one we've done was 30 or 40 people. But where we really like to dominate the market is buying from so-called indie hackers, so developers that bootstrap their company with product obsession, usually over a 10-year period, getting to anywhere between 1 and 5 million EBITDA with very small stuff. And the great thing about it that those people tend to be very introverted. They don't like to interact with a lot of people, so they build the product around themselves. And for such companies, usually we have a transition period anywhere between 3 and 6 months. So during the LOI negotiation, we would already try to identify a successor, general manager. That general manager then joins the due diligence process. We align together on the deal thesis, the key value drivers that Derrick mentioned. And then basically, as we buy the company, we would actually develop a joint strategy to hire more people and accelerate the growth. And therefore, the founder usually starts part-time and then moves out in 3-6 months. And I think we've done that successfully with a number of companies right now, and most of them have been successes. Where it's a bigger company, maybe that has a second layer of management, then we are, of course, happy to discuss incentives for those people to stay. But again, we really love those companies that have very small number of people and very high ARR per FTE. I would say anywhere between 500 and 1 million per FTE.
Daniel, what about you?
I think it's a fantastic question. The guiding philosophy that we approach opportunities with is that there's really no rigidity that we go into a situation assuming. If a founder wants to stay on for the next 5 to 10 years, we'll embrace that because of his or her vision. If a founder has a vision for departing after 1 to 2 years, that doesn't necessarily dilute the value of the company that they've built. So as a result, our portfolio has looked like buying businesses from founders who have run their business for 25, 30 years. backing a family-owned business that is changing the generations of management. Sometimes it's similar to how Pavel mentioned. It's the first institutional capital behind um, sustainable, profitable, and bootstrap businesses that have kept their head down, innovating on product for the last 5 to 10 years, and are now just picking their heads up and saying, "Hey, I need a partner who can help me churn through a few more innovation cycles." So our process and our view is that keeping founders is what we look for as a first step. Strong tech know-how in-house at every level of the organization, and look to acquihire, upgrade with top thinkers as the business matures. But ultimately, we expect to be partners in crime with our founders throughout a deal.
Sharon, is it different at Rockwell, or does it play out similarly?
Yeah, I would say it's very similar to Daniel. We work with our leaders that we're acquiring on their vision. Would they like to stay? Which we actually prefer. That's our preferred path. And in fact, we've had owners come in and take much bigger pieces of Rockwell's business and help us shape strategies, particularly around things like machine vision and AI. So our preference is for them to stay, and I think that's been our track record. But look, we're a big company, 25,000 employees. 8 to 9 billion of revenue. So sometimes that can be a shock for a small company. So sometimes we spend a lot of time around culture and what a good fit is, but it's really important to us to retain talent.
Coming to the end of our time here, but I do want to give Mike a chance to answer this because he literally wrote the book on it. So any last thoughts just on, especially kind of founders, CEOs joining a large organization like that, and kind of wisdom you've picked up?
No, for us, we do prefer that the founder stays on board in some way, shape, or form, and we actually prefer that they roll some equity with us going forward. And that may be, if they'd like to continue to be CEO, if we all agree, that's fine. But we ask them, what do you really enjoy doing day to day? And sometimes we're talking to these companies that are very for pharmaceutical services, biotech, and the founder will say, geez, I'm a PhD biochemist, I don't know how to take this company from 30 million to 130 million. I want to be the brand ambassador, I want to be publishing, I want to be presenting on the business, and that's great, but we really prefer them to be side by side with us than just exiting day one.
Well, everybody, thank you so much. Really appreciate it. There's just so much good stuff to unpack here. I hope that our audience has appreciated it as much as I have. I just want to thank each and every one of you for joining us today. And look forward to many more conversations in the future, both on deals and otherwise. Thanks, guys.